Hi everyone, I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month we're tackling a few of our clients' most frequently asked questions, which not surprisingly revolve around their biggest concerns, as well as the concerns of financial markets more broadly. So the first question relates to the current crisis in the regional bank sector and asks, will the stress in the regional banks lead to another financial crisis similar to what we experienced in 2008? So while the recent bank failures certainly have provided echoes of what we experienced in 2008, we think there's a couple of reasons why this time is very different than that environment. And the first is that the banking sector has undergone tremendous regulatory scrutiny over the past decade plus, which has resulted in the largest banks needing to have higher capital ratios and also undergo regular bank stress tests in order to avoid a situation like we had in 2008. And I think you've seen the fruit of all that regulatory framework imposed on the banks and the fact that the largest banks this time are acting like safe havens, whereas they were the epicenter of the crisis in 2008. That's not to say that the failures in the regional banking sector don't have an impact, because they do, but we think it's different in the sense that we're not talking about the risk of a financial meltdown. We're talking about the risk of bank lending essentially grinding to a halt and slowing the economy. Two very different things. The second reason why we think it's different this time around is that the balance sheet issues facing the regional banks revolve around well understood interest rate risks versus unknown credit risks. Thinking back to 2008, the subprime loan crisis really created a black hole of uncertainty for the large banks, where no one knew how much exposure the bank had to these pervasive bad loans. This time around, the losses that regional banks are facing on their balance sheet are tied to interest rate increases that are easily quantifiable and relatively well understood. Now, there's certainly been some regional banks that have mismanaged their balance sheets, and we've seen a few of those fail already. But by and large, the vast majority of banks have very manageable risks associated with their balance sheet and readily transparent. But it comes down to confidence for the regional banks, and confidence from depositors and market participants alike. And we may see more regional banks fail simply as a result of fear. On this front, we've been encouraged to see deposits at U.S. commercial banks stabilize in the past month, as shown in the chart on your screen from the Federal Reserve. You can see the deposit exodus that took place in March following the collapse of Silicon Valley Bank, but since then, deposits system-wide have largely been flat. Even data specific to regional banks has shown deposits stabilizing in recent weeks, despite continued pressure on their stock and bond prices. This is something we'll be watching closely going forward to better gauge the impact of the current bank turmoil on the broader economy. The second question relates to the debt ceiling saga and asks what will happen if Congress does not raise the debt ceiling in time. Well, as we've by now grown accustomed to, the debt ceiling debate is another opportunity for brinkmanship across our government, and with some risk that Congress underestimates the potential fallout from not raising the debt ceiling in time. Now, it's important to keep in mind that the debt ceiling has now been raised 102 times since World War II. And so our base case is that cooler heads will prevail and raise the debt ceiling maybe just in time. But given the elevated level of political polarization in our country, we have to think about the less favorable outcome. Now, were Congress not to raise the debt ceiling in time, it's important to recognize that that doesn't automatically mean the U.S. will default on its debt. We actually think the risk of the government not paying out interest and principal to bondholders is extremely low, because it is likely they will prioritize interest and principal payments on their bonds over allocations to other government programs. Now, not allocating to other government programs will have an impact on the economy, but it won't be the type of financial Armageddon that would arise were they to not meet their obligations on their debts. We think the bigger issue, even beyond the debt ceiling debate, is the fact that interest payments relative to the government's overall budget is set to surge to levels not seen in the last few decades, which is likely to crowd out government spending in various parts of the economy. This is the real issue that we need to be monitoring, given that it will impact future economic growth and interest rates, even beyond the current debt ceiling debate. And for our last question, our client asks, you've been discussing the probability of a recession occurring for the past 6 months or so, but I've seen only minor adjustments in my portfolio positioning. Why is that? Well, that's a great question, and it comes back to our conviction that a portfolio underpinned by a long-term strategic plan should not be significantly altered based on a market or economic forecast. We've been in this business long enough to know that our forecasts are certainly subject to change, and short-term market performance is impossible to predict with any consistency. Take this year, for example. Given the knowledge that 3 out of the top 4 bank failures in U.S. history would occur over a 4-month period, who would have predicted that the market would be positive over that same time frame? And this is why our approach to investing is to align your portfolio with our tactical views, but not to depart materially from your strategic long-term plan. Today, this may include holding a little more cash than usual given the favorable interest rate environment. It may include using structured notes to protect on the downside at the margin on your equity portfolio. Or, where suitable, it may include using alternatives to diversify your stock and bond portfolios. In every case, our goal, as always, is to construct a portfolio that we believe can meet your long-term goals as long as we stick with it through the ups and downs of the market. As always, we are grateful for the opportunity to partner with you in this important aspect of your life, and we'd encourage you to keep sending in your questions that we can address in future market updates. Thanks so much for listening, and we'll see you next time.